So let me first of all thank all members who have participated in this discussion related to the finance bill. As I initiated the discussion in the morning, I had very clearly said that at that stage I shall not speak too many details into the bill itself, but highlighted those acts in which amendments are being made, and some of which rightly the members expressed concern in the morning that may not come technically under the finance bill, but you have kindly heard us all out and spelt out your verdict on it. And the underlying point in this is, even if they are non-taxable matters, but because they have very important and critical impact on the finances of the state and also on the finances of the economy at large, it was felt imperative, and the imperative is the word which the rule allows us, that the government, if it feels there is an imperative to bring in such aspects of non-taxable matters also under the finance bill's amendment, it may be permitted. And you have taken a considered view on it and given us the permission to go ahead with the discussion after having taken cognizance of the members' concern. I'm very grateful for that. As always, let me very quickly run through the names of the members who have participated and given very valuable suggestions. Started with Shri Adir Ranjan Chaudhary of the Adir Ranjan Chaudhary ji, Nishikant Dubey ji, Srimati Sumati, Shri Mithun Reddy, Professor Saugata Roy, Shri Rajiv Ranjan Singh, Shri Rahul Ramesh Sivale, Bhartruhari Mehtab ji, Shri Ritesh Pandey ji, Shri Dr. Sanjay Jaiswal, Dr. Gaddam Ranjit Reddy, Srimati Supriya Sule, Shri K. Srinivas, Shri Subhash Chandra Baheria, Dr. S.T. Hassan, Shri E.T. Mohammed Bashir, Shri Ravi Krishna Kumar, and Shri N. Premachandran. So there are several issues which have been raised, all of which I can respond item by member, but holistically I would want to first of all draw the picture of what this finance bill aims at. If we have already set ourselves a 10-year vision, we are also setting ourselves a 5-year target, all of which was explained during the budget. This finance bill, through the finance bill, essentially through the various taxation proposals that we are bringing before you, we are underlining the fact that Make in India needs to be given greater push. And that is why when you look at the direct tax amendments, as I mentioned in the morning, are looking at 7 acts, all of which are getting amended in some way or the other, relate to the reduction in corporate tax rate, where in order to reduce the effective tax on corporates, it is proposed to provide the benefit of reduced corporate tax rate of 25% to all companies having an annual turnover of up to 400 crores. This will cover 99.3% of all the companies. All the companies, literally 99.3 of them are getting covered under the 25% rate, which was a goal set by the first budget of the previous NDA government led by Honorable Prime Minister Shri Narendra Modi. In 2014, it was promised that we will have this gliding path coming down from 30 to 25. We've reaching 25, now we've reached 99.3%. So it is important to do that amendment. The next is that incentives were being provided for purchase of electrical vehicles, and therefore it is an important step towards concern that we express on environment consciousness. And therefore, in order to incentivize purchase of electric vehicle by an individual, it is proposed to provide deduction of an amount of up to 1,50,000 for interest which are being paid on loans taken for the purchase of electrical vehicles. The loan is required to be taken on or before 31st March 2023. Now, further, many other acts of direct taxes will have to be changed only because several incentives for startups have been announced. Now, if I could just go through one or two of them without taking much time on this one item itself, is the condition for carry forward and set off of losses in cases of eligible startups is proposed to be relaxed, enabling them to carry forward their losses. Obviously, startups cannot be making profit even in the first or the second year. So we've been considerate because this is one demand which has come from startups. That is one of the things we are amending. Similarly, a provision is also being allowed for exemption of capital gains from sale of residential property, because many of the startups do sell their own properties which they own and invest in the business to start with. And for them, we need to give that concession. So on investment of net consideration in equity shares of eligible startups proposed to be extended by 2 years. The condition of minimum holding of 50% share capital is proposed to be relaxed to 25%. The restriction on transfer of computer or computer software is also proposed to be relaxed from the current 5 to 3 years. So like that, if I can go on adding for each category, the essence of the taxation proposals which are in the finance bill are, one, to promote greater ease of doing business, encouraging making in India, encouraging young entrepreneurs who want to do something, investing their own seed capital first. And that is the drive which Make in India requires now, because there's a lot of enthusiasm among people to want to move from a salary-paying job to creating jobs for others. Now, boost for affordable housing is something which I would like to underline, sir. Amendment again because of the incentives we want to give. In order to incentivize purchase of affordable houses, it is proposed to provide a deduction of up to 1.5 lakh for interest paid on loan taken for the purchase of an affordable house. This shall be in addition to the existing interest deduction of 2 lakhs. Again, for the increase of supply of affordable houses, it is proposed to relax the condition of 100% profit-linked deduction to affordable housing projects also, so that by increasing the limit of carpet area from 30 square meters to 60 square meters in metropolitan regions and from 60 square meters to 90 square meters in non-metropolitan regions. It is also proposed to align the limit on cost of the affordable house to 45 lakhs with GST acts also. So when I'm talking of direct taxes, I'm talking from the point of view of income-related taxes. This will have a bearing even on the GST tax amendments, which I'll list out when I'm talking about indirect taxes. Now, one of the major steps, sir, India, we wish, becomes a very big international financial hub. With a view to further incentivizing the IFSC, International Financial Services Center, it is proposed to provide several direct tax incentives to an IFC, including 100% profit-linked deduction under the Section 80 LA in any 10-year block within a 15-year period, exemption from dividend distribution tax, about which most members do express concern every now and then, from current and accumulated income to companies and mutual funds, exemptions on capital gain to Category 3 AIFs, and interest payment on loan taken from non-residents. So this is an important thing which we want to make sure that India becomes eventually one of the biggest international financial services center. I've explained during the presentation of the budget, sir, that for the issue of NBFCs, to address the concern which is now very clearly voiced by very many people, we have come up with a proposal that interest on bad and doubtful debts in the case of deposit-taking NBFCs and systemically important non-deposit-taking NBFCs, that is normally NBFCs, what is systemically important? You may ask me this question later. Systemically important non-deposit-taking NBFCs are nothing but those NBFCs with more than 500 crore asset base. So for these systemically important non-deposit taking NBFCs, they shall be charged on tax on receipt basis and not on accrual basis. This is an important change which is necessary considering the situation in which NBFCs will have to now be addressing the issues that they're facing, the challenges that they're facing. So it is also proposed to provide that deduction of such interest and shall be allowed to the payer on actual payment. So these are institutional and important steps. I won't take more time going to each one of them much more elaborately. The interchangeability of PAN and Aadhaar, I'm just coming one by one. I'm not citing per company or per issue, but NBFCs is being covered here. So, for addressing the NBFC's issue majorly and in a wider context, I've put it here, I'm not citing individual instances of companies or any which have faced crisis, for which the government's response is even otherwise available. The interchangeability of PAN and Aadhaar also requires certain kind of amendments, as much as pre-filling of returns. So then, again, many members have spoken about it. I'll address the issue. But one other thing which requires amendment is the issue of TDS on cash withdrawals, big cash withdrawals from bank. For withdrawals by a person, by an individual, in excess of 1 crore in a year from the bank account will be subject to 2% TDS. Here, even as I say, where it is required for some kind of amendments to take place because of this, I want to assure the members that if there are people who are tax-paying citizens who are withdrawn like this TDS will be adjusted with the total tax dues. So it's not over and above what is expected to pay as tax, but it is going to be reconciled with the total tax claim which can be laid on this individual. So it's not something running parallel to it. So if an individual has paid tax or is paying as an assessee, this 2% will also get reconciled to that. But if he is not one, obviously he'll have to pay the TDS. So then the deduction on tax by individuals or HUF. In this case, again, there's also this issue of FPIs, where you're trying to include tax deduction from HUFs and TDS. It has an impact on those FPIs who are registered as trusts. There's an option for FPIs to register as companies. But if as companies they register, they don't have the problem of this new tax that we're talking about. But when you're registered as a trust is treated as a taxable entity, and therefore as an individual entity, he comes under the taxation. So many of our officials have also been talking that such FPIs who have registered themselves as trusts may consider the option of wanting to move to be registered as companies. That is something which I like to highlight. Similarly, there are facilities which are being extended for low-cost electronic payments, because digitization and less cash usage is a priority for this government. Every attempt is being made for people to use some form of electronic payment, be it a card, be it a QR code, be it BHIM app, and in that process, it is not as if we are rejecting people from withdrawing their own cash deposited in the bank, but it is more to encourage those who can use the digital and electronic payment. And thereof, obviously, the amendment will affect the Payment and Settlement Systems Act, so that is also being listed under the direct taxation. So the other amendments are into the Black Money Act, the PMLA. On that, I would like to assure the members that the kind of amendments, in fact, I would like to mention that well before, that the number of amendments which are coming through for the PMLA Act, which is of 2002 vintage, 8 are being proposed by us. Of the 8, 6 are only explanation to the existing clause. The clause itself is not being changed. We are only coming with explanations so that in the courts, by some, pleading, those who are accused, pleading because of some kind of a confusion or a gray area or ambiguity which might exist, these explanations are being brought into the Act, and therefore the amendment is not amendment of the clause itself, it is more explaining the clause. So of the 8 amendments proposed under the PMLA, 6 of them are amendments only for additional explanations to be added. In fact, in this context, sir, I'm very grateful that you've given me the opportunity to be able to read out some passages, but I won't spend too much time on that particular thing, and I'm grateful that probably I would have waited for the conclusion of my talk, but then I'm very grateful that you've given me the permission to lay a statement describing the entire background and giving the justification for the amendments to the Prevention of Money Laundering Act 2002, which may be read as a part of my speech. But those 8 points on which the amendment is being brought in, as I said, 6 are only explanation. 1 is deletion of a proviso which had no purpose to be there, which was not being invoked, but of course being invoked by people who intend differently, and therefore that proviso is being removed, and a new proviso which is being added is only to make sure that where a case exists in one court and the hearings are going on there, and where in a different court there could be proceedings happening, these two cannot be clubbed or brought together as one and treated as one, and therefore that is set up a proceeding which is different, and the case otherwise is going on in a different court. We have treated them separately. To that extent, the proviso is being added. Therefore, as regards PMLA, I just want to be clear that the explanations which are going in are explanation to the existing clauses, and no new clauses are being added, except for one where we are bringing a proviso, and one proviso which is getting removed. As regards indirect taxes, sir, very quickly I'll move over. There are about 7 acts which are getting amended, with some amendments to 7 of them. In the morning I read a list of those 7. They are Customs Act, where we are making sure that we have the authority to check somebody who is suspicious, and even then when they are going to be put through the X-ray, they will be put through the X-ray only after they have been taken to a magistrate. So it's not as if the official at the airport who suspects somebody does it on his own. The amendment is more to give them the power so that they can take such people before a magistrate and say, we have strong evidence with a suspicion, we seek your permission, would you allow us to do an X-ray of this individual? So such kind of changes are being brought in, and therefore the Customs Act changes are largely to ensure that the customs does not suffer from dealing with people who have absolutely stood out there in the red line, and therefore they have to be acted upon. The second is on the customs tariffs. That's also being amended, because specific tariff lines for specific products will have to be brought in. Then there is, of course, the GST. Within the GST, under the GST head, there are 5 different amendments, all of which are GST Council cleared, meaning GST Council has approved it, and it is only that which is coming in. And I understand some of the members did have a concern about why will GST Council's decision come through this route. It is only because, yes, GST Council is a constitutional body, they can take a call, but anything to do with tax collection will have to go through the Parliament, will have to go through the Finance Bill. So, those decisions which have been approved by the GST Council are becoming a part of this Finance Bill. 8 of them are being listed, 8 with specific intents. Then, sir, I am talking also about the proposal proposal relating to GST is a tax. GST is a tax. Proposal relating to Prevention of Money Laundering Act. I've explained it, so I won't go further into that, sir. Financial markets. In the morning I did say there are 8 acts which are being amended, and listed out the names of them. Some are very, very simple changes, but the one which has probably attracted the attention of some of the members, about which they spoke, is the amendment to the Reserve Bank of India Act. I just want to underline as to what is being done on the Reserve Bank of India Act. The proposed amendment to the RBI Act is to strengthen RBI's regulatory powers. Powers over regulation for, on, and regulating the NBFCs. And therefore, the amendments have become necessary. Given the developments which all of us have observed in the last few months, particularly on the NBFCs. What are those powers? I'll take a minute to explain. Empowering the RBI to supersede the board of an NBFC, or to remove its directors, or to amalgamate, or to reconstruct, or to split an NBFC in public interest or for financial stability, or to remove and debar auditors, direct the inspection and audit of any group company of an NBFC. Also, to raise the net owned fund requirement of an NBFC, and also then to impose higher penalties in case of legal contraventions. These are the specific amendments to the RBI Act, all of which come because we want the RBI to take over regulating NBFCs. So the amendment to the RBI Act is with the specific intent of making the RBI a complete empowered regulator. The National Housing Bank is also something which we are making sure is better regulated. So there is returning the regulation authority again back to the RBI. Then the Banking Companies Act, amendment to the Insurance Act. The Insurance Act is important because I heard in the morning some members speak about it. I'll just let you know what is the particular amendment that we are doing. It is proposed to reduce from 5,000 rupees to 1,000 crore rupees, 5,000 crore of rupees to 1,000 crore, the net owned funds requirement for opening of branches of foreign reinsurers, for branches to be opened in the IFSC. There are amendments again to the general insurance which we are bringing in. And lastly, about the Central Road and Infrastructure Fund Act. Sir, in the morning itself, I did explain that this is again something only to bring clarity. None of the features of the Central Road and Infrastructure Fund is being changed. States will receive the monies as always. The clarity was required because there was always this narrative going around, is the center now cutting down or is the states not empowered? So there's nothing new there. It is only a matter of bringing greater clarity. There are particular questions which some of the members have asked. We've explained in the larger narrative. If some of them need to be explained, I'm willing to do it, but considering that I'm taking significant time, I do not wish to expand unless there is anything in particular which any member would want to say. I can take the case of Sri Ritesh Pandey, who spoke about digital payments to political parties cannot be traced. This is a matter of great interest for many of us. I'd like to explain it for a minute. Digital payments always leave a complete trail. The honorable member, I'm sure, is somewhere here. Digital payments always leave a complete trail from the destination to the source. Therefore, it is the government's policy to encourage digital payments and use less cash. Therefore, again, the statement is unfounded. Digital payments to political parties will make political donations more transparent. Sir, Dr. Saugata Roy and again Ritesh Pandeyji had spoken about cash withdrawals will adversely affect tea growers who have to pay in cash to their employees. The threshold, sir, I'm answering your question, sir. The threshold of TDS under Section 194N on cash withdrawals is deliberately set at 1 crore. It's deliberately set at 1 crore. Cash withdrawals of up to about 8 lakh per month will be excluded from the scope of Section 194N. Thus, small tea growers would not be affected by the TDS. Small tea growers will not be affected by the TDS. The large tea growers are expected to use banking facilities to make payments in line with the government's policy to encourage digital payments and more to move towards less cash transactions. Sir, Shri Bhartruhari Mehtabji spoke about increase in effective tax rate to 42.7% and that it will lead to flight of FPIs from India. I wish to respond to him, sir. Increase in effective tax rate applies only to individual taxpayers, including other forms of FPIs, as I explained a minute ago. those FPIs which are registered as trust, and trust is treated as an individual legal entity rather than a company. So, the increase in effective tax rate applies only to individual taxpayers, including other forms of FPIs such as trust, artificial juridical persons, etc., which are treated as individuals. FPIs organized as companies will not be affected by the increase in effective tax rate, and therefore the fear of flight of FPIs from India is not well founded at all. The increased effective tax rate will affect only high income individuals, and it is this government's policy that these individuals should contribute more towards nation building. So again, Sri Bhartrihari Mehtab had spoken about tax rates for domestic companies that are proposed at 25% for turnover or gross receipt of up to 400 crores as against 30% for other domestic companies and partnership firms. A very valid question, sir. I'd like to respond. The tax rates for domestic companies and partnership firms cannot be compared as distribution of profit to shareholders by domestic companies and is again subjected to dividend distribution tax at the rate of 15%. In contrast, distribution of profits to partners of partnerships from their capital account is not subjected to the tax either in the hands of partnership firms or partners. So there is a distinct difference. So, sir, I think most of the questions were covered, raised by different members, were covered in different answers that I've given. If there is anything in particular, there was this interesting question, sir, from Srimati Supriya Sule. Why not simplify tax by bringing new tax code? Why not relook at earlier code already examined by the Standing Committee on Finance headed by Sri Yashwant Sinha? So I just want to, and also I think one of the member, Honorable Member Bashir, had said there should be no delay in tax code. So I just want to respond, sir. Task force is already working on finalizing the report on a new direct tax code, and therefore, which is required actually to be submitted by 31st July. The government will receive the report and we shall take a call on it. So with all this said, as I said earlier, I'll respond, sir, but that's not part of my finance bill. So if you permit me, I'll answer, but that's not part of the finance bill at all. But disability pension, since the Honourable Member has raised, I would like to say the tax deduction which was there, which was removed, was done with the advice of the Armed Forces Headquarters. The Ministry of Defence or Ministry of Finance have not taken a call on their own. It was a recommendation given by the Armed Forces Headquarters. So I understand the concern of the Honourable Member. It's not a part of my finance bill, but I still would want to honour him with the answer. And the answer is, it's not a decision taken without the recommendation of the Armed Forces Headquarters. So with all this, I would like to repeat that I'm very grateful to you for having given me the chance to respond, and also for giving me the permission to lay a statement describing the amendments to and the background and justification for all the amendments which are being made to the PMLA, and therefore that may be treated as part of what I've spoken today and be treated as read. So with these words, I'm again very grateful to all the members who spoke on the finance bill. The intent of the government is to ensure that minimum government, maximum governance. Ease of living is the primary driving force of Prime Minister Modi, where we are making sure that every citizen completely is bereft of all the due diligence issues. The pain of having to be governed should not be on the citizen. We are trying to reduce the pain and making sure ease of living dominates in everything that we do as regards taxation. Thank you very much, sir.
माननीय वित्त मंत्री जी ने एक वक्तव्य सदन के पटल पर भी